This is consolidation subsequent to the date of acquisition, Chapter 3. So we are going to talk about to recognize the complexities in preparing consolidated financial reports that emerge from the passage of time. So in Chapter 2, everything that we did was at the acquisition date, the date of the transaction. Now time is going to pass, so there's other things that you must do. The passage of time creates complexities for internal record keeping, and balance of the investment account varies due to whatever accounting method is used. A worksheet and consolidation entries are used to eliminate the investment account and record the subsidiaries, assets, and liabilities to create a single set of financial statements for the combined business entity. Learning Objective 3-2. Identify and describe the various methods available to the parent company in order to maintain its investment in the subsidiary account and its internal records. So, for each subsidiary owned an asset, the investment account and the income account are created to record earnings on the investment. The acquiring company must select one of three methods that have emerged as the most prominent for accounting for investments. The equity method, which we covered in Chapter 1, which we will talk about again here, the initial value or cost method, and then the partial equity method. I'm not going to go too much into partial equity. We're basically going to cover equity and initial value method. What's the advantage? The equity method if you use this, the acquiring company gives a true representation of consolidated figures. The initial value method, or cost, is easy to apply and gives a good measure of cash flow generated by the investment. And a partial equity usually gives balances approximated to consolidated figures, but is easier to apply than the true equity method. Comparison of internal reportings of investment methods. So, if you choose the equity method, you will continually adjust to reflect ownership of the acquired company. Income accrues as earned, amortization and other adjustments are recognized. If you have the initial value method, it remains at cost, dividends are declared and recorded as dividend income. And a partial equity adjusts only for accrued income and dividends by the declared company. Income is accrued as earned, but there's no other adjustments, so there's no amortization. To prepare a consolidated financial statement subsequent to acquisition when the parent has applied its internal records, the equity method, the initial value method, and the partial equity method. Okay. Subsequent to the consolidation, during the year, the parent will adjust the investment account for the subsidiary under the application of the equity method. The original investment is recorded at date of acquisition and adjusted for fair market value adjustments to other intangible assets, the parent's share of the sub's income or loss, the receipt of dividends from the sub. So let's use an example. Parent company obtains all of the outstanding common stock for Sun Company on January 1st, 2014. Parent acquires the stock for $800,000 in cash, below are the balances of Sun. So book value of Sun, net book value is $600,000, fair value is $720,000, and here are the differences. So you would start on acquisition date, January 1, and record fair market value of the consideration transferred, or the purchase price, $800,000, less the book value, equals the excess over book value. You're going to allocate that to the specific differences in fair value, which $20,000 was for trademarks, $130,000, and equipment was overvalued by $30,000. So that's $120,000, and the remaining is Goodwill. Now you're going to compute amortization. The trademark has an indefinite life, so there will be no amortization. The patented technology has 10 years. So you divide the $130,000, which is the fair market value difference, by 10. So $13,000 in amortization. And the equipment is negative, so it's going to go the opposite way. It's overvalued. And so you divide that by 5 years, which is $6,000 a year, and you don't amortize Goodwill. So 13 minus 6 is $7,000 in amortization. Amortization will be $7,000 annually for 5 years until the equipment fair value reduction is fully removed. Here's what it would look like, assuming that Sun Company earns $100,000 in 2014 and pays a dividend, a cash of $40,000 on August 1st. So you would record the investment. This is on the parents or parent which is the parent company. Investment in son company, 800,000. Credit cash, 800,000. Then dividend receivable on August 1st, 40,000. Investment in son company. So you're going to reduce this investment account by the dividend. Cash on 8/8, they received the money, and dividend receivable. So they were going to get rid of the receivable. Then on 12/31, you recognize the $100,000 in income, investment in son company, equity in subsidiary earnings. And you're accruing 100% because we own 100%. In the first chapter, we accrued a portion of it because we only owned a portion. Equity in subsidiary earnings, 7,000. So this is to recognize the amortization. So you reduce the equity in subsidiary earnings and you reduce the investment account. For the first year, the parent prepares 5 entries on the consolidated worksheet. Entry S, which we've already done, eliminates the subsidiary stockholder equity account balances and the book value component within the parent's investment account. So we eliminate the retained earnings if they have it, common stock, additional paid-in capital, all of the stockholder equity accounts. A, recognize the unamortized allocations of the beginning of the current year's adjusted fair value. So these are the fair value differences. I eliminates the income accrued by the parent. Remember, we're using equity methods. So on December 31st, we wrote in income, but I is going to eliminate that. D eliminates the subsidiary's dividends. And E recognizes excess amortization expense for the current period on allocations from original fair value adjustments. Okay, so here's what S would look like. If you went back to the very first slide at the example, we are getting rid of the book value of the company here. Additional paid-in capital, common stock, additional paid-in capital, and retained earnings as of 1/1. And this is the book value of the company. So consolidation S does that. If this is the first year of the investment and the investment was made at the time other than the beginning of the fiscal year, then some pre-acquisition income of the subsidiary was already accounted for. But we bought it on 1/1 to make that easier. Now A, adjust to fair value. So you're increasing the trademarks, patented technology, and goodwill, and decreasing equipment and the investment account. Consolidation entry I, equity earnings and subsidiary. This is the net, the 100,000 minus the $7,000 in amortization. So we're removing the income recognized and the amortization. And then consolidation entry D, dividends. That's how I remember D. I, income. D, dividends. D removes intra-entity transfer for cash dividends. So investment, they're going to debit the investment account and credit dividends declared. And then E is the depreciation expenses reduced for tangible assets, equipment, fair value less the book value. Patented technology was recognized for the year. So they're going to debit amortization expense, and then they're also debiting equipment because before we were crediting equipment. And then they're going to credit patented technology, and then on the equipment, they're going to credit depreciation expense because it was overvalued on the books. The parent can also use, so that was equity method. If they apply the equity method, that's what you will do. Now, the parent can also use the initial value method or the partial equity method. Application of either of these alternatives changes the balance recorded by the parent over time and the consolidation process, but neither of these approaches will affect the final consolidated balances. So no matter what approach you use, the final balance will always be the same. But the adjusting entries, the consolidation entries, will differ depending on what you're doing during the year. Just 3 parents' accounts will vary. The investment account will change because if you're not recording it at fair market value all the time and adjusting it, if it's just initial value, then it'll remain the same. Income recognized, if you're not recording income, and then retained earnings after combination year. If the initial value method by the parent is used to account for the investment, the consolidation entries will change slightly. The parent will record the sub's activity different under this method, so accounts will differ from the equity method. There is no adjustment needed for are recorded in the investment account for the current year income or dividends paid by the subsidiary or amortization of the purchase, and dividends received are recorded as dividend revenue. So, two entries for the initial value method are different than those for the equity method. Entry S and A are the same. So no matter which method we're doing here, S and A are the same, which we did in chapter 2. Now entry I, if you're using the initial value method, is different. It eliminates the parent's dividend account and the sub's dividends paid, and there is no entry D. And entry E is the same as the equity method. On the partial equity, which I'm not going to cover, but you can read the slide if you want to learn more about it. So remember, entries S, A, and E are always the same no matter what of the three methods you're choosing. The parent's record keeping is limited to 2 periodic journals, annual accrual of income and receipt of dividends. So the investment and income account balances differ depending on the method, and so will worksheets entries I and D. So I and D are the only ones that are going to differ. S, A, and E are the same. Neither the initial value or the partial equity method provides a full accrual measure of the subsidiary's activity in the income. The initial value method uses a cash basis for income recognition, and the partial equity only partially accrues some of the subsidiary's income. A new worksheet adjustment is needed to convert the parent's beginning of the year retained earnings balance to a full accrual basis. This is considered consolidation purposes. The beginning retained earnings account must be increased if you're using the initial value method, or decreased if you're using partial equity, to create the same effect as the equity method. So entry C refers to the conversion being made by the equity method full accrual totals. The asterisk indicates that this entry is solely to transactions for prior periods. Entry C should be recorded before other worksheet entries to align the beginning balances for the year. In addition to entries S, A, I, D, E, and C, intercompany payables, or P, payables and receivables, must be eliminated by entry P. No matter which method the parent chooses to record the subsidiary's activity, the consolidated totals are always the same. I can't say this enough. It does not matter which method. The consolidation entries at I, D, and C could change, but the total consolidated balances will always be the same. So these are consolidated totals subsequent to acquisition. The current revenues. The parent's revenues are included. Subsidiaries' revenues are included, but only for the period since acquisition. Current expenses are included of the parent, and the subsidiaries' expenses are only included for the period since acquisition. Amortization expense of the excess fair value allocations are included by recognition on the worksheet. Investment or dividend income. Income recognized by the parent is eliminated and effectively replaced by the subsidiary's revenue and expense accounts. Retained earnings beginning balance. The parent's balance is included when you consolidate the totals, and the change in the subsidiary's balance since acquisition is included as a regular accrual by the parent through a worksheet entry to increase the parent's balance. Past amortization of excess fair value are included as either part of the parent's balance or through a worksheet entry. Assets and liabilities. Parents' balances are included. Subsidiaries' balances are after adjusting for acquisition date fair values, and intercompany payables and receivables are eliminated. Goodwill in the investment of the subsidiary. Original fair value allocation is included. Asset account recorded by the parent is eliminated on the worksheet so that the balance is not to include consolidated figures. And then capital stock and additional paid-in capital. It's the parent's balance only, although they will have been adjusted at acquisition if stock was sold, but only the parent's balance. A parent's choice of internal accounting method for the subsidiary investment has no effect on the resulting consolidation financial statements. The selection of a particular method does not affect the totals ultimately reported. That's why you can choose any of the methods. The internal accounting method used does require distinct procedures for consolidated financial statements from the separate organizations. I will just briefly talk about what goodwill and other intangible assets are. Um, Goodwill and other intangible assets provide accounting standards for our FASB ASC topic 350 for income statement effects of the impairment of intangibles acquired in a business combination. In accounting for goodwill subsequent to the acquisition date, GAAP requires an impairment approach rather than amortization. Remember, we don't amortize goodwill. Once goodwill has been recorded, the value will remain unchanged until 1. All or part of the related subsidiary is sold. So if you sell all or part of it, then you'll have to change the goodwill. Or there has been a permanent decline in the value in which we test for impairment and record an impairment loss if the item is impaired. I'm going to discuss this, but we're not going to go too far into goodwill impairment in this chapter. The fair value, which with allocated goodwill is compared to the carrying value, including goodwill, of the consolidated reporting unit. Does the fair value of the reporting unit exceed carrying value? Yes. Goodwill is not impaired. No further testing is required. So if fair value exceeds carrying value, then there's no reason to adjust goodwill. If no, you must go to a second step to test for impairment. The second step is the implied value of goodwill is calculated similar to the determination of goodwill in a business combination. You allocate fair value of the reporting unit to all of its identifiable assets. Subtract the fair value of the net assets from the fair value of the reporting unit. The excess is implied goodwill. Compare the implied goodwill with the recorded goodwill. Evaluate relevant events or circumstances to determine whether it's more likely than not that the fair value of the reporting unit is less than the carrying amount. If it's more likely than not that the fair value of the unit is less than the reporting unit, if you go to yes, compare the calculated fair value to its carrying value. Is the fair value less than the carrying value? No, you should stop. If implied goodwill is less than recorded goodwill, and you ask that question, if the answer is no, goodwill is not impaired. If the answer is yes, an impaired loss is recorded for the excess carrying value over implied fair value. And this is that question we left off on. If the fair value of the reporting unit is less than the carrying value, yes, you go to step 2. If the answer is yes, you recognize the impairment. I'm going to skip this. We're not going to do an example of this. So other intangibles. All identified intangible assets with finite lives should be amortized over their economic useful life and reflects the pattern of decline in an economic useful asset. Factors that should be considering when determining useful life are legal, regulatory, or contractual provisions, and the effects of obsolescence, demand, competition, industry stability, rate of technology change, and expected changes in distribution channels. So, learning objective 7, understand the accounting and reporting for contingent consideration subsequent to the balance sheet. If part of the consideration being transferred at acquisition is contingent on a future event, then the acquiring firm estimates the fair value of the cash contingency and records a contingent liability at the present value of the future payment. The liability will continue to be measured at fair value with adjustments recognized in income. Contingent stock payments are reported as component of stockholders' equity and are not remeasured at fair value. We're not going to cover push down, and that's it. This is an overview of chapter 3, and then we'll do examples of how to actually make the consolidated worksheet.